We first have Harshit Joshi, who's one of our panelists today. He's a founding partner at Favcy Venture Builders. It's the largest venture builder in India. He has a bachelor's degree from Shahid Sukhdev College of Business Studies. He has built startups like Discount Kar De and PGP Digital. One of the best ways to describe him, he wears multiple hats. So he is leading the founder selection. He leads the investments vertical. And in the last 3 years, okay, he's built 27 plus startups from an idea stage to a scalable business. 27. It is an absolute honor to have you here with us, Harshit. I'm so looking forward to learning from you today.
Thank you, Krishna. You're too kind. It's been a very exciting journey over the last few years, and the 27 ventures that the venture builder that we've got here are definitely one of those achievements that we fondly look at. But definitely eager to build more. And thanks for having me here, guys.
Thank you so much, Harshit. We move on to Amit Gupta. Amit is there's only one word which best describes Amit. He's a deal maker. Let me change that. He's a deal enabler, right? He is somebody who has demonstrated a history of over 20 years, nothing to do with a particular sector, nothing to do with any particular company. He has done it across sales, across GTM, across alliances, across product, across ideation, e-commerce, funding. Most recently, you would have seen Amit Gupta. He was involved with the startup and VC ecosystem, and he has scaled up as many ventures as possible as founder, advisor, operator. He is from North London, Arsenal. He has grown up and lived and worked across geographies from Western Europe, America, Africa. He is currently a director at Factoryal. He leads the growth practice, and he's there for helping with organic and inorganic journeys. Thank you so much for joining us, Amit. I can't say enough how much I'm looking forward to learning from all of you here today.
Thank you, Krishna. I mean, again, you're far too kind in giving that introduction. I'm looking forward as well to this engaging discussion, and happy to give my viewpoints on the topic. Thank you again.
Rohan, is Eklavya here?
No, but I think we'll begin.
I see somebody with Eklavya's name. So is that him?
Just check.
Yeah. Hi. Sorry for the delay.
Hey, Eklavya. No problem.
Really
No
sorry.
problem. No problem. I was just about to introduce you.
No, really sorry.
No problem. No problem at all. I was just about to introduce you. So great timing. Guys, Eklavya Gupta is the co-founder, co-CEO of the Recur Club. He's an engineering alumnus from NSIT Delhi. He's an MBA from IIM Calcutta. He's been an investment professional for 11 years. He's invested across capital markets, private equity. He's worked in Nomura, Kotak, Mahindra, Bank of America, Merrill Lynch, Ivanhoe Cambridge. And overall, if you put together his entire body of work, he's done transactions over $10 billion. The Recur Club in itself is Asia's largest revenue exchange. So what they do is it enables trade of future revenue streams for upfront growth capital, right? So it's an investment where we are giving you some money in the hope of future revenue streams. Companies are allowed to raise up to 50% of annual recurring revenue. This is an important concept. So for example, if someone sells you a product, right? It's a one-time transaction, you buy it and you go away. But if you buy something like a software as a service, where it's a recurring revenue every year, that's called annual recurring revenue. So he allows companies to raise 50% of their annual recurring revenue within 48 hours, no equity dilution, and no obligation of any restricted debt. Welcome to this meeting, Eklavya. It's an absolute pleasure to have you. I think I'm just going to shut up now, and I would love to give the stage to Rohan. Rohan, over to you. One last request, please, guys, videos on, right? Please, guys, help me out here. I need videos on. Over to you, Rohan.
Thanks so much, Krishna, for that wonderful introduction, and super excited to have Harshit, Amit, and Eklavya on this panel. Over the past 7 to 8 years of being in the startup ecosystem, both as an entrepreneur and as a mentor to other startups, one key question that keeps coming up is first-time founders can often get overwhelmed in building their startups while also think about how to grow their startups and approach external investors. And one of the burning questions that comes up is, how do we get ready to become ready for future investment or approaching for investors in India or in our that operate in our sector? So this panel discussion is geared more towards understanding how can founders, especially first-time founders, bridge that gap between building a product and making their products investment ready or their startups investment ready. So I welcome all of you, Harshit, Eklavya, and Amit, to this panel. Very excited to have you on. Now, Harshit, we'll start with you. In your journey of building ventures and also enabling other other founders in this space, what are the non-negotiables that you prepare them for in terms of, let's say, helping them approach fundraising from a different perspective, or putting together a checklist of sorts in terms of getting them investment ready? So do you have a set list of non-negotiables that you consider in your process?
For sure, Rohan, for sure. And again, thanks for having me here tonight, and happy to share whatever I can from the experience that our limited portfolio has shown us, and what we try to help them inculcate in their fundraising journey. The most important aspect is to actually put yourself in the investor's shoes. A lot of times, founders believe that money can actually solve more problems than it actually can, and that's where there are certain key parameters that every founder should ideally look out for, and that's what we try to help our portfolio companies and their founders identify. The first is when you really start out, right, at a very early stage, you are identifying a certain problem statement that you're looking to solve. But that problem statement with your solution will also have certain hypotheses that you're looking to validate as you go to market. What an investor is really looking at is some validation of those hypotheses, because of course you are trying to solve for something which hasn't been solved before. So there has to be some validation for that any investor will look for. And I mean, the icing on the cake for any investor would be some predictability to that. What predictability brings to the table for any investor is essentially knowing that, okay, if I'm putting an X amount into this venture, of course, I mean, there's a great presentation that is there, and there's a slide on fund utilization and all that. But what I'm really concerned about as an investor is, okay, how exactly is this going to play out in the ventures journey in the next 6 to 12 months? Because for me as an investor, when I've entered, it is only fruitful for me if I am able to eventually sell my investment. And that is possible as the company grows and future investors also come in. So at the kind of early stage at which we operate, and we actually start working with founders as early as an idea stage before they've even formed companies. So we actually try to focus on these basic elements to make sure that when a founder is able to go to market, they're able to move towards validating the hypothesis around the problem statement and the solution that they're looking to bring to the market, as well as bringing some sort of predictability to how revenues are backing their problem statements and solutions. So that's broadly what we look at in terms of pure non-negotiables, because we also have a fund called Open Book VC that invests in the top performing portfolio companies emerging from the venture builder. And that's obviously a matrix that we follow when picking out the top companies from the Favcy VV portfolio.
Got it. Okay, understood. So you're looking for a combination of a solid business plan backed by a viable precedent in terms of what they hope to achieve, combined with some predictability of future returns for the investor. Understood. Amit, how about you? In your experience of advising and mentoring startups over the past 2 decades,
Right.
what has been your journey in supporting entrepreneurs in taking their concept from, let's say, idea to execution? What have been the non-negotiables for you in your journey?
Right. So yeah, again, thank you for having me, Rohan. So I mean, to add to what Harshit said, I mean, there are no one size fits all kind of a rule book to say. Every investor would have their own thesis and philosophy in terms of what they're looking at a founder. But there's still a few non-negotiables, or let's say basic principles that a founder, whether a first-time one or a serial entrepreneur or somebody who's entering the entrepreneurial space after a corporate career, they need to keep in mind. Number one is to have a clear and compelling vision for your company. I mean, I wouldn't go into the problem statement or the solution, which Harshit already alluded to, right? Once you figure that out, you're trying to solve a large problem, you've ideated on a solution, then of course it's necessary to have a vision for your company. I mean, where do you see yourself in that whole story? Along with that, you need to have a very solid understanding of the market and your target audience. That's where I believe a lot of founders get it wrong. They launch an MVP, they just go to market, but they don't have an understanding of the target consumer base that they're targeting, right? Along with that, I would also advise founders to focus on having a very strong and experienced second level team along with them, apart from the founders itself, right? And of course, they need to have a well-researched and detailed business plan in place, right? That's, few of the prerequisites that need to be in place. And then, of course, as Harshit rightly said, you need to put yourself in the investor's shoes, right? I mean, you can't think in silos that, okay, I've built a product, I have a company, and this is what I intend to do. I mean, think for a moment that out of the hundreds of proposals or investment decks that an investor looks at, yours is just one of them. So you need to be standing out, you need to have a compelling vision, as I earlier said, and demonstrate those moats. I mean, what are the compelling moats that you've built around your business? So, and then as you go along, it's very important for you to display that conviction in your business and just get a buy-in from the investor. I mean, it takes a while for the investor to understand your storyline and the business model. So, all in all, I would say is think from the other end also. That would be my parting statement. Yeah.
Great. Thank you so much, Amit. Coming to you, Eklavya, Recur has backed more than 1,500 founders in its journey so far. In your mind, what has enabled you to buy into those founders and create that non-negotiable checklist for you at Recur? So any thoughts on that?
Absolutely. And firstly, apologies, I'm not able to switch on my video.
No worries.
Just in a bad network area. Really sorry for that. I think so. From an investment point of view, whether it's an equity investment or the alternative investment, I think it varies drastically. But the fundamental, I would say, founders should focus on three things, right? Like, which I personally call, and we have heard probably as the three T's, right? Like the team, as people mentioned, the first team and the second team. The second team point is very, very important, right? But so is the first team. If you're in the early journey, if you don't have a first team, second team doesn't follow. The TAM, right? Like the total addressable market, the potential at which the business could scale to. Because from an investor point of view, they're investing into you today, assuming that you will scale in the business and take a market share, etc. Right? It's simple math. So it's a bet on what potential market could you reach with that team, and then if you have any potential revenues, etc., then it's the traction, right? So I think team, TAM, and traction. I think these are the three T's that are very, very important for any business. Now, traction could be in terms of if it's very early, then product interviews, etc. If it's little mature, in terms of the users that you have, so further mature than the revenues that you have, right? So I think if people focus high level on these three T's, right, and then everything falls within those subcategories, right? This is from an equity point of view. From our Recur point of view and alternative investment options point of view, I think what is very, very important is to have predictability in your revenue. So we come only after you start generating, say, at least a 10 lakh rupee monthly revenue, right? Like that's the minimum threshold. It's not much, but it gives us some sense for the models to predict, because our investors are not taking an equity bet. And founders today are actually lucky to have this option, if you'll ask me, right? Like, because otherwise we have seen if people keep on taking a lot of equity, after 5-6 years, founders are in single digit shareholding, right? So people should balance these two things. But I think fundamentally, while building the product for any investor, right, especially from an equity point of view, I would say the team, TAM, and traction is extremely important, right? Like that is what people look for, in terms of their due diligence.
Great, thank you so much, Eklavya, and that really puts in a perspective of from an investor perspective as well. And Harshit and Amit, please feel free to jump in as well if you want to add anything. My next question, before I move on to the next question, I'd encourage everyone to drop in your questions. We have a 20-minute Q&A in the end where we'll hope to answer most of these questions from the panel. Amit, you mentioned about having a vision in the beginning when you're building out an idea and approaching investors. But often what happens is during the validation stage, this vision might change when they get, a certain different result in terms of market validation, or they change their approach in the building process. So how do you suggest navigating that from the founder's perspective? And how does an investor look at this from a long-term vision perspective? So any thoughts on that?
Yeah, sure. So, as I said in my opening statement, having a long-term vision helps the founder. I mean, more often than not, I've seen, in my interaction with several founders that I do on a daily basis, they're very short-term oriented, and I don't blame them because they're chasing, growth metrics that they're forced to chase, right? So they keep a very short-term approach. Now, short-term could be a quarter or maybe 6 months or so, and somehow they get bogged down in that or boxed in with that. But when they're starting out, it's very necessary for them to go back to that ideation stage. And quite often, I often recommend it to the entrepreneurs and founders that we advise in our portfolio, right? Go back to that drawing board. I mean, what was the sense of purpose and direction that you started with, right? Purpose is actually one of my favorite themes. I mean, everybody needs to start with a sense of purpose and direction. So when you go back to that drawing board, you see what was the vision that helped you align the team. You need to have shared goals, which gave you that sense of purpose. So in order to get out of that short-term thinking, which you've been forced to adapt due to, economic conditions, or like, for example, currently we are going through this funding winter, as they say, right? Everybody is forced to go back to the drawing board, focus on fundamentals, basics, unit economics, cash flow, cash burn, and all those things. And it's very, it's particularly important for early stage startups. They were always, they're battling, they're firefighting, they're battling so many hiccups at every point. And they're working with limited resources. And there's a high degree of uncertainty around their business models. So what a long-term vision does is it provides them a basic framework for decision making, and it's easier for them to prioritize, number one, and make decisions on those difficult trade-offs. Right? Trade-offs would be like, do I chase customers constantly, or do I focus on my existing customers, and so on and so forth. Do I go in for organic growth in this environment, especially, or do I keep up with my outreach towards investors? So these are trade-offs, right? But once you have that vision in place, it helps founders to stay focused on, the most important aspects of the business, and they get, it helps them avoid getting bogged down in minor details. Having a short-term approach, you're always firefighting those day-to-day issues, right? But if you have a perspective on things, a long-term approach, you necessarily don't get so bogged down, And lastly, it's a very powerful tool for fundraising also, because you're able to sell that long-term story, as Harshit said in his statement, in his opening statement. See, every investor is looking for that exit opportunity somewhere down the road, and you need to create that compelling story and sell it to the investor, right? How do you sell that story, right? I mean, you have to have that vision and able to translate that vision into numbers and metrics, and somehow, just give it out to the investors. So that's why having that long-term vision, and it helps you stay motivated, engaged. Setbacks are always going to be there. I mean, each day you have several setbacks. I mean, you're firefighting across the board, right? So having that sense of perspective and keeping that big picture always in mind, it's very important, right? So yeah, I believe, navigating that whole journey is very important for the founder and entrepreneurs, and somehow sell that vision to the investors, right?
Understood. Got it. Thanks, Amit. Harshit, how about you at Favcy Venture Builders? You take founders from and their visions from idea to execution. So how do you help them navigate these challenges, if any? And is there a process that you follow with respect to that?
For sure. I think Amit actually covered a lot when it comes to the vision and how it probably helps a company. At Favcy, we're hardcore operators, right? We're actually helping founders with very simply just an idea to translate that into a digital product, a tech-first company, and actually go to market and build from there. So maybe what I'll do is I'll wear an operator's hat and talk about probably the vision that you need to have for your customers right at the start. And this might sound overrated, but it's actually very critical at the start of your ideation journey itself. I'll maybe just take a couple of steps back and take you to an example of, let's say, a Zomato, right? When we look at Zomato, most of us, we just look at it from a consumer's lens. But if you also notice, a key customer for Zomato is the restaurant, which is where they actually monetize. And if you also chalk out what they have very beautifully laid out in terms of a vision to add value to that customer, right? They've actually been able to build lifetime value by contributing towards multiple problems that customer has. They not only are helping with, let's say, deliveries and getting access to customers through their online ordering platform, but for those of you who know, they've acquired a company called Hyperpure, which is actually the back-end supply chain for providing raw material to restaurants. Now, what they've very beautifully done, right? They've identified a customer. Now they've got this vision to increase the lifetime value of that customer. Why I like taking this example is because I think at the start of it, a vision for your company will obviously get you far in terms of how Amit very beautifully articulated. But I think a vision for your customer is also equally important as an operator, because then you truly know that, okay, at the start of it, this is how I'm looking to add value. But because because most of the ventures we work with are digital first and tech first, you know that there's going to be that inherent lifetime value of a customer when they come back and they transact and they repeat transact and they repeat transact. And for that, if you have that very clear clarity of, the vision that will give your customers more value, therefore extending the lifetime value of a customer for your business, you're actually in a very beautiful spot because you've got that articulated at the get-go and you know the direction in which you're building for your customer. So I think while the vision for your company, of course, needless to say, will take you far, the clarity for what vision you hold for your customers will allow you to build in the right direction. That's definitely one of the things that we touch upon when we're evaluating startups and guiding our companies at the very early stages.
Understood. Great. So vision for customer is very exciting. Eklavya, what's your thought on that perspective, in that both as an investor, from an investor perspective, as well as an entrepreneur perspective, what do you think of this, of having a long-term vision for a customer versus short-term vision as well, and combining that with a long-term vision?
Yes, I think both are equally important, right? Like while long-term vision is extremely pertinent and extremely important for any company, right? Like because otherwise you will go directionless. But I would strongly advise, especially in the early days, right? Like while you have gotten to an idea, I think execution is that what differentiates, a lot of companies, right? Like after a point in time, because if you are doing something good, there will be copies, there will be replicates, right? And hence the importance of team that comes into picture plays a big role. Because and internally also as an entrepreneur, I keep on telling my team, that you should basically, if obviously long-term vision, so strategize for that, right? Like what plan for the execution on your quarterly basis. So I think a lot of startups I've seen not using KPIs and OKRs effectively, but you should use that, right? Like, because that aligns you with your long-term vision and short-term goals, right? Both, because OKRs are long-term objectives, and then you bifurcate your short-term, key results and action to what you want to achieve, and hence because they are not separate, right? Like both of them go hand in hand. So strategy and execution go equally important, and then bifurcate in weekdays, right? Like so in a startup, right? Like every day is so different. Every day is so important. Every hour in a startup is equivalent to every day in a typical corporate, to be honest, right? Like that's the speed at which successful startups operate, to be honest, right? Like, and we have evaluated a lot of them, we ourselves and others, right? Like so, I think extremely important to balance the two. Because it's easy, right? Like to keep on thinking about a lot of long-term strategies, etc. But businesses change quite drastically, right? Like the world is so dynamic. In 1 year, maybe you are targeting, and that's the reason 90% of the startups pivot all the time because the world is so dynamic, right? Like so, while it's very important to have long-term vision, long-term idea with which you enter in, but be very execution focused in the interim. Follow OKRs very effectively, right? And I think there will be a lot of noise, right? I think really want to highlight that. Saw it myself and with a lot of founders that I've interacted actively. there is a lot of noise in the market, right? So you have to get into a knack to ignore the noise and focus on what you're building, right? You will hear investors when you start speaking to some equity investors, they'll say, you know, kisi ne banaya. You know, it's very easy for them to just say it. But you really know what the differentiation factor is. Like you've thought through and when you get into it. So stick to that, ignore the noise, focus on your business, focus on execution, and definitely focus on customers, right? As people are saying. Because once you do that, right, like investors will follow up. Money chases good companies. So focus on good strategy, good execution, good planning, you know, focus on that. Money will keep on following. There are enough and more options today, right? Like, and with alternate options, as I mentioned earlier, right? Like there are much more options that people can get at the right point in time. Capital is very important because again, 50-60% of this companies die down because of lack of capital. And hence alternative capitals have picked up drastically. But don't go for that capital. Go for the customer capital will chase you, right? Like the right direction. But ignore the noise, focus on that, and take strategy and execution on the one. You can't segregate both of them.
Great. Thanks so much, Eklavya. You talked about KPIs and OKRs, which brings me to my next question is there a right moment for a founder to approach fundraising? So is there, let's say, often we see that founders approach fundraising to either too soon or too late. So is there a sweet spot in terms of a certain milestone that founders can look at before they approach investors? So what's your take on that? Eklavya, you're muted. Yeah.
Okay, sorry. So I think right stage of investment. So what kind of capital you want to take? Right. I think first decide where do you want to use that capital? How much capital do you want to take? I think clarity on that 99% of the founders don't have. They go to the market, they see that, oh, I want a $10 million value and the seed round and the pre-seed round. I don't want to value more than 15%, so let me raise $1.5 million. But do you need $1.5 million? What would you do with that $1.5 million? I think 50% of the startups are not clear. Like it's in air, I will hire. But have that plan ready, at least for the next 6 months, you know, you could exactly know because you know what you want to do. So right stage. So if you do angel and pre-seed seed investment, right, like that comes before revenue, right? Like, so take a small angel round or accelerator or pre-seed rounds in my view, when you don't have any revenue, right? Go for that. Build a team, build some traction. Because if you go to bigger VCs right up, right, they will take a lot of equity, I'll be honest, right? So you will end up giving 35% of equity, which doesn't make sense at that stage. So be very meticulous, be very particular, you know, choose wisely. Go for seed round, see what amount of capital. It varies from business to business, so I can't put a number to it. But don't value too much really upfront, I think, because the equity and time are the two most precious assets that a founder has, right? Like any company has. Just preserve equity, right? Time, unfortunately, you can't, you have to give it time. But once you get some traction going on, then you go for your, you know, seed, Series A round, smart VC, and they will come in themselves, right? Different stages. So I will not go into too much detail, but you know, it depends on either what kind of revenue scale have you hit, or if you are, you know, just a user acquisition company. Currently, in the current macro, you need to start generating revenue if you have to go to a big VC. They want to see traction, right? They will not trust you before that. You will only end up wasting. They will do calls, they will do meetings, but you will only end up wasting your time. So don't be in a rush, right? Like I've seen a lot of founders telling me, oh, that investor messaged me or email me, I'm going to speak to them. If you're not raising, don't be shy and tell them upfront. Even your time is very precious, right? They are just getting market info at times. So be very, very thoughtful about it and say that, hey, I'm not raising currently, and so don't be shy with that, right? Like, and then go next, you know, whenever you think is the right time, and be upfront, right? Like, and investors like such founders because they exactly know what to prioritize, when to prioritize, right? If they are betting on founders and the team, you know, they want to see these characteristics as well. So don't be anti them, you know, be friendly, be transparent, I think. And then angel round is must, I would say, angel / accelerator initially to get you going. If you want to go for an alpha growth, right? Otherwise, you have to put in your own equity money somewhere. So it's a choice between, you know, those two options. Once you get some traction, you know, obviously currently you have platforms like Recur Club, right? Like which we take pride in because that was a clear market cap, right? Like hardly 2% of companies got equity at that stage, right? Like doesn't mean 98% of the companies are bad. they are not having that hockey stick growth, right? Or the 100% growth that equity guys would want probably. And hence, leverage platform like us, there are a couple of others alternative investment platforms depending on the type of businesses that one wants to focus, and conjunct it with, equity, etc. From a accelerator, but preserve. Don't dilute more than 10-15% in your, first round. And then if you want to do another round, again 10-15%, not more than that, right? Like don't end up diluting 50% of the company in 2 rounds, because long term it will take a hit, right? Like for example, Zomato, right? Like Dipinder Goyal holds less than 5%, right? Like at IPO, 3%, right? Like so it's a great company, nothing against him. That's a solid $10 billion plus kind of valuation as they listed, etc. Right? Like, but your skin in the game, right? Like think, why did you start that startup? Right? Like, it's also on the long run to retain that control. So are you losing that control, right? In the long run. So there are multiple factors. So just be very cautious, and don't be in a rush. Be very thoughtful about it. And don't dilute more than 10-15% in any round that you start, especially when starting a business.
Understood. Great. Thanks so much, Eklavya, for highlighting that. Harshit, in your experience, is there a sweet spot that you recommend first-time founders or entrepreneurs to go out in the market and raise funds, raise that first angel round, as Eklavya suggested, or do you look at certain milestones in your journey? What's your take on that?
So Rohan, we actually, as I mentioned earlier, we started working with founders at an idea stage, and the top portfolio companies emerging from Favcy Venture Builders, they're able to raise funds from our venture capital fund, Open Book VC. Right. But I wouldn't go into too many details there, purely because I think there's a more important aspect that a founder needs to probably ask themselves, and I feel that we don't talk about it enough. I think the first question that a founder needs to maybe answer is, do I even want to raise funds? What founders often don't realize is that a venture capital fund, and for those of us here who may not be aware, I mean, most venture capital funds, all venture capital funds in India, all of them holding a SEBI registered license, they're all limited fund life licenses, which means that every venture capital fund has a start date and a stop date, and they need to return capital to their investors by the end of that horizon. What that naturally means is that as soon as they invest in a startup, they are actually bound by their own limitations to force the founder to get on a treadmill and actually run at a certain speed. My biggest question to most founders at the kind of stage that we interact with them at is, do you want to go down that road, or do you want to sustainably build a venture that is maybe completely bootstrapped? And we actually don't talk about these companies a lot, but if you look at a Zoho, for example, right? It's that other Z other than Zomato, which is not spoken about enough. But Zoho never raised any capital, and they're actually massive. If you were to actually look at their journey, again, they've taken longer to reach where they've reached, but they've done it without raising external capital. They've done it at their own speed, and they've done it, far more successfully than most companies who actually raise venture capital. So, I mean, instead of maybe going deeper into when to raise, I would actually suggest and force founders to take a step back and actually ask themselves whether they want to raise capital in the first place. If they do, honestly, there's many ways to figure out when to raise funds. But if I were to also looking at the time, I mean, maybe just try to summarize it in one line. When you have complete clarity in terms of what you are seeking to achieve with those funds, and you're able to put it transparently in front of your investors, as long as they have a buy-in to what your vision with that capital is, you're on the right track. If you have to actually, package it in a manner that an investor will buy into it, whereas that you may not have answers, maybe it's not the right time to raise funds. That's probably my one-line, suggestion on when to raise funds if you choose to raise funds.
Understood. Great. That's a great perspective as to understanding whether or not you need funds in the first place. So that's a great perspective, Harshit. Thanks for sharing. Amit, how about you? In your experience, what have you seen in terms of the right approach or the milestones to consider during fundraising, if any, in your time?
So, yeah, right. I mean, Eklavya and Harshit have already alluded to most of the points, and especially Harshit said more than do you want to raise the funds or not is the most important question. But again, having said that, I mean, there's no one size fits all answer to founders knowing when it's the right moment. I mean, it's highly dependent on the specific circumstances of the company and the sector that they operate in. But typically, founders should consider approaching investors. Again, once they've achieved those internal milestones that they set when they set out with their business plan, right? Now, those milestones could be varied, right? I mean, it could be traction in terms of users, it could be traction in terms of revenue, and any external factors which are compelling them to go to market. When I say go to market, approaching investors, right? So it's very important for them to know, do I actually need that money, and how long is it going to serve me, right? For example, we are in this situation currently, which is again called the funding winter. Many of these founders are going back to the drawing board in terms of focusing on their unit economics, having a very tight grip on their cash burn, and so on and so forth, right? So you really need to figure out, do you actually need that capital? And once you've answered that question internally, I mean, again, as both Harshit and Eklavya said, there are various options, right? You're no longer restricted just to VC money. I mean, there's debt financing available to you, there's revenue-based financing available to you, and so on and so forth, right? So, I mean, you can have internal milestones, but, I would suggest not to have a spray and pray approach, right? I mean, that's one of the things that I'm actually completely against, right? Never have that approach that, okay, let me just go out in the market and test it out. So I'll send my deck to 50, 60 people and just pray. This is called a spray and pray approach, that somebody is going to get back to me because I'm just trying to test the waters. No, they can never be a test the waters kind of a strategy. Once you're in the market, you're in the market, and signals are very important, right? So what kind of signals are you giving to your potential investors? It's very, important. So again, I mean, there's no one size fits all kind of an approach. I mean, you have to figure it out depending on what stage your company is at, and why do you need that capital, right? Once you've answered those questions, then I think the journey becomes slightly easier. And rather than chasing investors, I mean, I'd look at it the opposite way. Have the investors chase you. If you put out a compelling storyline in the market, there's no dearth of investors. I've experienced it myself. Investors would come towards you. I mean, they know how to scout for deals. Investors get a healthy deal flow through various sources. So, yeah, I mean, yeah, that's what I would sum it up as.
Great. Thanks so much, Amit. Amit, you also mentioned about unit economics and the importance of maintaining a strict cash flow. And the current environment that we're seeing in startups is, the VCs or the investors are focusing more on sustainable growth versus vanity metrics that we've seen in so many years. So how do you suggest startup founders to navigate this environment and, approach it from the right perspective that founders should do, rather than approaching these vanity metrics that VCs or just generally are accepted in the market today? So what's your take on that?
Right. So I'll go back to what Harshit was trying to allude to and point out, right? Every VC has an exit horizon, right? The minute he invests, he expects the founders to be on that literal treadmill, right? And if the founder's been running at, let's say, 7 miles an hour, I mean, of course, he would like them to start sprinting or, be on a 10 mile per hour kind of a speed, right? What does that do to the founder's mindset, right? It compels him to grow the business much more than it's organically growing, right? So, but it's kind of a balancing act that the founders need to navigate, as they're building out on their vision. So it's important to grow the metrics, have a finger on that pulse, keep looking at those unit economics, and have a tight leash on your cash burn. But then again, on the other end, you have these investors, like, for example, what we are seeing currently happening. I mean, I'm not going to name names, but, just last week, we had a particular company in the automobile sector imploding. Why was it imploding? Because they were found, doing some number crunching on Excel sheets, which they were forced to do, right? They couldn't achieve those metrics, and, they got kind of creative with their numbers, and eventually the story came out, and they're in the middle of an audit. Now, why did that situation arise? Because they were after this growth at all costs kind of a mentality. But on the other hand, if you're going for a sustainable growth, right? I would personally advise founders, to focus on building a strong foundation for the business and prioritize profitability and cash flow over short-term growth. Short-term growth can get you from A to B, but it's very important for you to go from B to C, D, E, and F, right? I mean, if you just reach from A to B, I mean, you're doing, let's say, $1 million annually, and your target is to reach to be a $5 million company in the next 2 years. So you can't have a short-term vision and just leap or skip steps, right? You need to go step by step. In terms of fundraising, if you do a seed round, then you go to a pre-series A, series A, B. You can't skip those steps. Running a startup, as it's a cliched line. It's like running a marathon, right? So you can't have those 100-meter sprints, even though you have the investors on your head. But provided you've got that buy-in from the investors, you've sold your long-term vision, I mean, keep giving them regular updates. Tell them that, this is what is realistically possible. This is what is not possible, So I think if you have your finger on the pulse, concentrate on all these realistic metrics, right? I mean, the fundamentals of any business remain the same, by the way, right? So you can weather any economic downturn and, you can continue to grow in the long term. So, again, my advice is chase growth, but sustainable growth. It's very important for you to have that vision that this is where I need to be in the next 3 to 5 years, right? I am going to survive somehow. And there's no point chasing those 3-month, 6-month targets and forcing my team to somehow get there. So, yeah. That's how I would sum it up. Yeah.
Great. Thanks so much, Amit. Harshit, how about you? What's your take on this?
I actually really, appreciate the note on which Amit, left it in terms of finding that balance. Honestly, it is very tricky for founders to really understand what that balance is. And, when we're working with portfolio ventures at the kind of very early stage that they're at, they're also looking for those answers, which is where, I would like to allude to, the rule of 40. It is a principle that I would encourage all members here, if they haven't heard of it before, do read about it more. It's a very simple principle. It says that your combined growth rate and your profit margin, if you were to take your X% growth rate and your Y% profit margin, it should at least be 40%. So it should be equal to 40% or more than 40%. That's the balance striking mechanism that the rule of 40 alludes towards. And I would genuinely encourage people to read more about that, because it really helps you, identify that measurable outcome that you're chasing as a founder, because there's a lot to read out there. There's a lot to read out there, and often first-time founders are not sure whether they should be going after growth at all costs, whether they should be balancing that with their profit margins. But there is that balance that you can really strike if you were to follow a principle like that. That's the one I love most. And that's where I, as an operator, really come from. And yeah, I think that's my one-line answer there. That if you really want to abide by a principle, the rule of 40 is something that you should definitely look at.
Wonderful. Very interesting. And Eklavya, what do you think about this from an investor perspective, and from your experience at Recur and your prior investor experience? What's your take on sustainability versus growth at all costs?
No, I think sustainable growth, right? Like what was mentioned, they always have to balance, right? Especially in the current macro, right? There are cycles. In certain cycles where there's flow of money, when people were doing anything and everything in 2021, for example, right? At that time, people forgot sustainability, right? People were saying growth, valuation, raise money, that's it, right? But that's a very short-term myopic view, right? Like never take that when you're building a company, because by saying that your value has increased from 100 to 300 because the market cycles are so, doesn't mean that you are exiting at 300, right? Like at the end of the day, because you are only going to make money as shareholders when you exit. So valuation, interim discovery or inflation in valuation doesn't help anyone, right? Like even the investors and the founders. So be very thorough, be very practical, don't run out of it. it's a very small example I'll take, right? Like a couple of my friend founders raised their equity round in 2021 at crazy valuations, right? Like that we know today. And their employees were very happy because so did their ESOPs values increase, etc. In 2022 end, right? Like very recently they wanted to do another round and the valuation almost 50% of it. So while founders were okay, shareholders were okay, but to tell this to employees that hey, your ESOP value was worth 1,000. Now after 1.5 years it was 500. Not everyone will connect with it, right? And they had mass erosion from their company, right? So I think there are multiple factors. If you don't try and keep, the fair game for long-term sustainability, some of the key factors that people look for, investors, key metrics, etc., that people look for, right? It varies drastically from business to business. But focus on your revenue potential, focus on your burn, especially in the current times, right? There is a key metric called burn multiple, which is how much cash do you burn, and how much additional ARR or annual recurring revenue do you generate from that, right? So keep that burn multiple minimal, right? If you can keep it less than 1, nothing like that, right? If you keep it more than 1, currently in this scenario, it's okay. If it's more than 2, I think it's very bad. So I think in today's macro, that burn multiple is a very important factor. Obviously, the other metrics like your ARR, growth rates, LTV to CAC is another metric for a lot of startups. I think people should value because it's basically a return on investment. For every dollar that you put, what is the lifetime value that you can generate from a customer, right? So I think focus heavily on these two, other than the Rule of 40, etc., that's been discussed, or not repeat. But I think we burn multiple in today's macro for the next 6 months, if you'll ask me, I think is one of the most important factors. And your cash runway, have clear visibility on what your cash runway is. Don't wait for the last minute. That a lot of founders say that, hey, I have 15 months of runway, right? I don't need cash, right? Like, but if you have to raise equity, it takes 6 to 9 months, right? Like, so start preparing for it. And or use alternate options when you have 12 months of runway. Don't wait when you have 3-4 months of runway that I should see what to do. You will be in a soup, right? Like, because alternate options will not come to them. So don't wait for the very last moment, right? Plan it well, from that point of view.
Very interesting. Thank you so much, Eklavya. We are running short of time, so I'll save the other 2 questions maybe for some other time, maybe for a future panel discussion, but we'll move on to questions now. We'll take 2 or 3 questions. I think Krishna already took the first shot before the meeting. He committed to asking the first question. So Krishna, over to you.
Thank you so much, Rohan. Some small privileges. So one key takeaway to everyone in the meeting today, just so you guys know, the word vision was used 31 times today. That says a lot to me. Okay, there were 4 or 5 questions asked to the panelists, and they used the word vision 31 times today. Interpret that how you guys want to. So my question is this: if you guys come up with an investment opportunity in a sector that you're excited about, and then you see 2 or 3 companies almost equally there, would you invest in all 3, or would you invest in one and allow that to compete with the other and help them out massively? Would you invest in more companies together in the same sector, or would you take all your bets in one company in one sector?
Harshit, how about you? Do you want to take this up?
Sure. So as operators, right, as venture builders, when we are actually practically like co-founders working with startups, it does not perhaps make a lot of sense for us, at least, to work with multiple ventures that are trying to solve the same problem. So at least in terms of the thesis that we follow here at Favcy, we stick to finding that one horse for a certain, vertical, I would say. While our entire thesis is fairly horizontal, we are sector agnostic in the sense that we are not focused on any particular sectors. So long as the founder comes from a non-tech background, has the business building understanding, and is looking to solve a large enough problem that can be solved using a digital first, tech first platform, we're happy to take our bets on them, so long as it meets our selection criteria. But while we have that very horizontal approach, when it comes down to a particular vertical, we try to focus on one portfolio venture alone, to make sure that we are putting all our might behind that one winning horse that we believe can go the farthest. And I think as a venture builder, that may be very unique to us, because a venture capital fund perhaps would definitely have a slightly different approach. And perhaps Amit and Eklavya can touch upon those aspects, because I think that's a little away from our thesis.
Amit, how about you? Any take on that?
Yeah, right. While I'd like to, I want to agree with Harshit that, betting on too many horses running the same race is not a good strategy, right? From my perspective, being an angel, also an active angel in the ecosystem. So, as Krishna said, they probably compare well together, all these 2-3 companies, if we're looking at them. But then you come down to some fundamentals. What do you look at? You look at the founding team, you look at the founder's pedigree, you look at the management team, and then of course you go down to the metrics of the business, right? How much traction do they have? What is the key USP of one of them? What are the moats that they've built against each other or in the market? And again, I don't think it makes sense to bet on multiple companies in the same sector. So I would also bet, and strongly back one of those companies, right? Once I've made my evaluation, on several parameters. Some tangibles are always there, but a lot of intangibles come into the picture as well. So I think, to just sum it up, right? It's always wise and prudent to single out one of those, no matter how much time it takes. It could be a while before you figure out or get that gut feeling on who is the clear winner. You might not have a clear answer to who's going to be the winner in the long term, but still, I would place my bets on one of those single companies, right?
Great. Thank you so much, Amit. There's one question here that is particularly interesting in the chat is what kind of decisions are you part of in a company or in an entrepreneurial journey as an operator, Harshit, or as an investor or an advisor? So Harshit, do you want to take first crack at this? So what kind of decisions do you feel that you are part of versus what kind of decisions can the entrepreneur take independently? So what's your take on that?
Sure. Happy to pitch in on that one, Rohan. So I'll actually just give you a very transparent picture of how we operate as a venture builder. As a part of our selection process, we're truly looking to evaluate the problem statement, the solution, whatever data points the founder brings in terms of the insights that they have from the market that are backing their argument for a certain hypothesis that they're looking to actually go to market with. And while there is that scientific process to idea validation, business model evaluation, it is that very stage before we extend a term sheet to a founder, where we actually try to align expectations in terms of what the next few months could look like, whether it is to do with the go-to-market strategy or how we are actually looking to collectively solve for predictable revenue at a certain stage. At that point, I think we've actually built into a fair amount of clarity with the founders, and we like to leave it to the founders to actually go on to their own journeys, because at the end of the day, it is a founder's journey, right? We're actually a very small contributor in that journey. Having said that, of course, we are always there in terms of when any founder hits a roadblock, or when exactly, or whenever there's a rainy day, right? Because these journeys are difficult, and you need that friend that can help you out on a tough day. So we try to be there, but it is actually at the start of the journey itself when we roll out a term sheet that we define what the coming few months could look like and the direction that we're looking to build upon.
Great. Okay. Thanks so much, Harshit. Eklavya, how about you from your perspective at Recur Club? What kind of decisions do you participate in the founder's journey as well?
So given that Recur is not an equity platform, so we don't have rights, etc. So officially, we don't have board seats, observer seats, etc., which typically an equity investor would have. But we have a team, which acts, because we as a platform that provides non-dilutive growth capital, but also provides, advisory services, help them grow using data. Because it's early stage, I think, right, advisory is important, and guidance is important. Leverage from others' experience is important, but we also leverage data. So we have a product within Recur called Recur Insights, which helps companies, keep their management dashboards up to date at all point in time, right? Because we anyways have that data when we evaluate them for financing, so they can integrate. We just integrate with their tech softwares, banking softwares, and keep that live for A, investor reporting as well, plus B, internal management dashboards. plus also do certain benchmarking, primary benchmarking that, hey, you are growing at this rate, but your competitors in this industry, in your size sector are growing at YY rate, right? Or your CAC is higher than the market, or your churn rates are lower, so which is great, etc. So those kind of actionable insight based on data, I think that is the most important advisory part that we do, leveraging data, because that's the source of truth to a lot of these from Recur.
Got it. Okay, great. I think we are running short of time, so I think this is we have a lot more interesting questions, but since we're short on time, we'll end the discussion here. Thank you so much, Harshit, Amit, and Eklavya for joining this panel and sharing your wonderful insights. I think for me and for the audience, it was a really insightful discussion and lots to take away and a lot of learnings from the session. So thank you so much, all three of you, to come in on a Thursday evening and sharing your insights. So thank you so much.
Thanks, Rohan, for having us here. I understand there's a lot of questions in the chat box. If any of you need any help with any of that, or if you're on your journey, I've sent my LinkedIn profile on the chat. You can connect with me, ask me your questions on LinkedIn if I can help. Very happy to. And thanks again, Rohan, for having me here. Truly a pleasure.
Thanks so much, Harshit. Thanks,
Rohan. Thanks, everyone. It was lovely speaking. Very
Thanks,
insightful
Rohan.
questions, must say, for sure.
Thanks a lot, Amit. And
Thanks.
Thank you.
Thank you, Rohan. Yeah.
Thanks,
Bye,
Rohan.
Been a
Thanks,
pleasure.
Harshit,
Been a pleasure.
Amit, Eklavya. And
Thank
happy
you.
Republic Day to everyone.
Yeah.
Happy Republic Day.
Happy Republic Day.
Thanks, guys. All right.